scenario. Started talking. He and I got together several months back, and we talked about what can we do to really create something bigger than what we are independently. It became very, very clear how big these revenue synergies are. So we're really excited about the future. And again, I think, Morgan, what's important to understand, this is about the reindustrialization of America and how rail can play a huge part in facilitating the move of goods.
And I do want to get into that a little bit more. But first, Jim, historically, consolidation in the rail industry, and especially if you look back to the 1990s, it's been a tough sell. There's been concerns about reduced competition, service snarls, cost cuts, reduced workforce, impacts to safety. How do you counter all of that now?
Well, listen, that's a long time ago, and it's amazing how people look back 25 years ago and talk about it, and those are lessons learned. But if you take a look at the way we're operating the railroad today, we've made some major changes. We've changed out our base fundamental technology platform seamlessly at Union Pacific, and we have a smart way to operate, and we know that we can have a transition that we're going to work through in detail with Norfolk Southern that is not going to have the same issues that it had before. We have guaranteed jobs for anybody that's unionized at Norfolk Southern and at Union Pacific, because we're absolutely sure we're going to be growing our business. So we've thought this through very carefully, and we're prepared to move ahead in a very, very logical manner.
And we're going to spend 2 years now planning. While this is under review, we're going to really start advanced planning on integration so that we can hit the ground running when it is approved.
You bet.
And make sure that we don't have any level of disruption.
So in light of that, have regulators signaled an openness to you potentially doing this deal? How did you get comfortable with the regulatory risk? And perhaps just as importantly, how much hinges on this open seat at the Surface Transportation Board and what that nominee looks like?
Well, Morgan, the way I look at it is this, we knew when we started to talk and when we decided to merge that we were going to have to go through a process with the Surface Transportation Board. We like what we've heard from the Surface Transportation Board and the new chair on how they want to follow strict rules about how we move decisions forward. So we're looking forward to it. We have a strong case. It's all about delivering for America. It's delivering for our customers, having a better service product, and absolutely making it so that they can move it at a very much better cost-effective manner because of the amount of touch points we remove on rail cars. We're excited about it.
Mark, how do you get labor on board?
Well, as Jim mentioned, we're going to have guarantees for the union workers. So we're going to engage with labor. And I think at the end of the day, this is about growth in America. So we're going to need more workers than fewer workers.
Jim, you're viewed as a disciple of Hunter Harrison, precision scheduled railroading. How does that factor into the combination of this network and how you can improve service and offer value to shippers?
Well, Morgan, that's a great question. And we would not be able to cross the first hurdle in this transaction in getting it completed if we did not operate a railroad that is very efficient. And if you take a look at our last quarter, we're the most efficient railroad in North America at Union Pacific. Our service metrics were outstanding, and we measure what we sold our customers. So if fundamentally you have a strong balance sheet, strong company financially, you're providing service at a high level, you know how to operate and use your assets, and we always carry a buffer. We understand that it's an outdoor sport that we're in. So we carry a buffer of locomotives, we carry a buffer of people, we carry a buffer of assets, and our network has a buffer of capacity so we can win. So I'm excited. That's what precision scheduled railroading is all about. It's really simple. The problem with it is the execution's a little harder. I've been doing it for a long time. I think we've got this.
Finally, we've got 6 Class 1 railroads, at least until this deal closes. Looking across the industry, is this going to trigger more consolidation?
We know for us, this is a win. This is a win for our customers, win for America. I leave the rest of them to do what they have to do. This is the way I look at it. If you stand still, you get left behind. We look at what's possible at Union Pacific, and the discussions with Norfolk Southern the same. It's what's possible, and we're real happy with what we're doing. Mark, any comment on that?
Yeah, we don't control what the others decide to do. We welcome it if they do decide to get together, and if they don't, that's fine too. Right now, we're focused on building a better future for the country.
Yeah, and certainly the macroeconomic landscape, and as you just touched on, reindustrialization of America, sort of speaking to the moment for this milestone deal. Jim Venna and Mark George, thank you so much for joining me.
Thank you very much, Morgan.
Thank you, Morgan.
Appreciate it.
Take
Thanks
care.
for having us on.
Thanks.
David?
All right. Thank you, Morgan Brennan, for bringing that to us as well. Not unexpectedly, of course, the two gentlemen behind the deal pushing the benefits for America, the public benefit, which is something the Surface Transportation Board will actually decide on, and the reindustrialization.
Is it good for America?
They will say Transcontinental Railroad is good for America. In fact,
They said it a bunch of times.
They said it over and over again. They did a very good job in terms of how they were advised to speak about the deal. But that's going to be the key here, not to make light of it. And I think the expectation is, and Jim Venna, I believe, this is what led to my reporting on this a few weeks back, had already done a lot of the groundwork in terms of in D.C., Sarah, trying to make sure that if in fact they did present this deal to regulators, it would have a good shot of getting through, and stressing the themes that clearly are of interest in this administration, and potentially adding jobs and the infrastructure, the reindustrialization, the efficiency, the fact that other countries have transcontinental railroads, an American, super rail, if you will. And so that's where they're going to go, and we'll see what the STB decides. It will obviously take some time. And more importantly, and Morgan asked this at the end of the interview, will we see Burlington Northern and CSX similarly join hands to present another union to the STB at the same time, so they can decide at the STB either both are allowed or both are not, because they wouldn't go one way yes and one way no.
Is that what you're reporting indicates?
That would be, I mean, that would be highly unusual, one would expect. There's the 4-member board, 2 Democrats, 2 Republicans, but one Democrat falls off towards the end of the year, and the president, he has the power here to appoint whoever he wants. So once again, a lot of this comes back to President Trump.
And the unions, he said in the interview that they're going to guarantee jobs, which I think is probably helpful for those that are unionized at Norfolk. We've got a lot to talk about. Here's our roadmap for the rest of the hour. Prescription for volatility. Novo Nordisk and United Health both sinking, while AstraZeneca gains on earnings. Much more on all of those healthcare movers, including a conversation with AstraZeneca's CEO.
Plus, consumer confidence data just out, following some mixed signals on spending from earnings. We're going to talk about top plays in consumer-facing stocks.
And Boeing does beat the street. We'll break down the company's turnaround plan after a big rally so far this year. One of the best-performing Dow names here to date, as we're once again in a tight range. 6,400. Squawk on the Streets back after this.
now and make it count.
I like the way this tariff situation is playing out. It's good for our business. It's good for aerospace, the aerospace industry in the U.S. Going to create great jobs, and I think that's what the administration's focused on doing.
That was Boeing CEO Kelly Ortberg last hour praising the state of these trade deals. Boeing initially higher on the results, did turn lower in some early trading. Joining us this morning, Jefferies analyst Sheila Kahyaoglu has a 265 target and a buy rating on the stock. Sheila, it's great to see you. Some of these numbers are impressive in defense, revenue, services, free cash flow. Obviously, you clearly don't think the street has quite caught up yet.
Yeah, I think these results were very good across the board. Commercial and services beat our margin estimate. Defense did really well. The free cash flow burn was only $200 million. Street anticipated about $2 billion. Free cash flow burn year to date is 2.2. These numbers overall are very solid.
Where do you think, any idea about why we took a turn lower here this morning?
I think stock's up 33% year to date at 230, one of the best performers year to date. I think it's just taking a breather. We already saw the 737 and 87 rates going to 38 and 7 a month when Boeing reported deliveries 2 weeks ago. And so maybe the street wants to see more free cash flow momentum. But I think the tariff point is one to harp on with Boeing because I think it's one of the best tariff plays out there, just given the order momentum the company could build on.
Right. It definitely it carries a lot of water on trade when we're talking about buying and selling an aircraft. This IAM issue regarding the defense workers in St. Louis, is that going to get material?
I think it'll pass, and it's only 2% of the workforce, much smaller than Renton was at about 30%.
Yeah, I just wanted to follow up on what you just said about trade, which is a big deal. And Kelly sounded very complimentary of the administration. I mean, I saw it even before they started announcing trade deals in the Middle East, where there were all sorts of commitments to buy Boeings, and then now in some of these trade deals. How much is it moving the needle for Boeing in terms of added business?
I think a lot. I think people don't realize Boeing's backlog is 7 years of production right now. And year to date, Boeing has about 650 official orders, but the trade deals are still preliminary. So they're not in that 650 number. We're tallying about 450 preliminary orders from the trade deals. That includes Qatar, Indonesia, Japan, and much more to come with the EU deal too. So I think that the tariff trade deal is going to build order momentum. And given the backlog is 7 years, is going to help pricing, which obviously helps free cash flow.
Viewers obviously remember how it was bedeviled for several years. Just concerns around the culture regarding safety. How do we talk about the stock right now through that lens? And do you give Ortberg credit for turning that whole engine around?
Yeah, I think Kelly Ortberg, Stephanie Pope, Brian West in his last quarter are all turning it around. Kelly's being very, programmatic, systematic with how he's thinking about the rate increases. We've now reached 38 a month on the 737, which is 50% of Boeing's free cash flow on our estimates. So thinking about going up in rate, but taking a close look at the KPIs and staying at the same rate for 6 months before really increasing. So I think it's slow and steady wins the race, and the momentum's building, and the culture seems to be moving forward in a positive manner.
On that monthly production rate, what's a truly aspirational number? I've seen 42 thrown around, but what do you have in your models for the coming years?
So we have 5 a month, an increase of 5 per month. So we'll go to 42 next. They'll stay at that rate for 6 months, and then 47. They've never really done above 55 for more than 6 months. So that is 52 to 55 is our target in 28. Per month. That's a lot of aircraft.
Yeah, it's a lot of aircraft. Where does, in an environment where defense clearly gets a lot of chatter on the street, where does that fit in on this story?
I also want to go back to the order momentum point. I think Boeing delivering on time without concessions and a good product. Outside of volume, pricing is very important as these tariff deals come in too. People will want the aircraft, will pay a premium for it to get it on time, to have it as people fight for capacity. On defense, we're starting to see the turnaround. This is the second quarter in a row where BDS hasn't seen any losses. So hopefully this is a business that generated $2 billion of EBIT and free cash flow just 5 years ago before the loss-making programs came in.
fascinating turnaround that it's been. It's been great to watch. Sheila, appreciate the help. We'll see where we get on the name as we work through the next few months. Sheila Kayalu on Boeing.
Thanks.
Coming up, Novo Nordisk plummeting double digits after a weight loss warning and news of a new CEO. Stock's down more than 20%. We have details for you next. Plus, exclusive comments from the CEO of AstraZeneca on tariffs, GLP-1s, and reports the company is looking to move its headquarters to the U.S. And the playbook for consumer stocks after confidence numbers topped estimates. Got that at the top of the hour. Let's see which stocks to buy. Still a big show for you. We'll be right back.
Wealth management begins and ends with you. We believe the more personal the solution, the more powerful the result. We treat your goals as our own. We never lose focus on the life you want to build. And our experienced advisors design custom-built strategies to help you get there. It's time for a wealth management experience as sophisticated as you are. It's time for Corient.
At Public Rec, we're on a mission to make comfort look good. We develop premium performance fabrics that are built to last, easy to care for, and hard to live without. Our Daymaker pads, with their various sizing options, are designed to fit your life's moments, no matter what comes your way or how you spend your day. More comfortable than jeans, more stylish than sweats. Public Rec, where comfort rules.
Dear Dr. K, I used to think I was never meant to be beautiful. I was teased because of my teeth. I didn't like the person looking back at me in the mirror. I never thought I could afford dental implants. You and your team worked within my budget and helped me feel confident in the plan we made together. I love my new smile. Thank you.
Congratulations, Cynthia.
Introducing our new lifetime warranty on zirconia arches, only at ClearChoice. Call to schedule a free consultation.
My name is Mike Hammond, founder of Cigna Relief. Much of my career has been working in construction. I love outdoors and horses. That active lifestyle is what has caused my body to hurt. I didn't want to let this affect my family or my life, and that's what motivated me to create a team to build the Cigna Relief Patch, clinically proven to reduce the impact of pain. The patch is a game changer. No creams, no pills, no wires. The patch is reusable and there's a real money-back guarantee. Whether it's your neck, back, knee, shoulder, or just aches and pains, this patch can give you your life back. When I gave my best friend a patch with tears in his eyes, he said it was the first time in 16 years he did not hurt. Join the hundreds of thousands who found relief. I'm asking you to try the Cigna Relief Patch today by going to our website. If you're thinking about buying, it means you need one. You have nothing to lose. I promise the patch works.
CNBC. Live ambitiously. Wednesday, August 6th, join CNBC's virtual small business playbook event, Real World Insights, on navigating volatility and seizing opportunity. Register now at cnbcevents.com/smallbiz.
We are about 30 minutes into the hour. Here are some big movers we're watching. Chip designer Cadence Design leading the S&P after top and bottom line beat, also raised guidance. United Healthcare under pressure again after the company said 2025 earnings will be worse than expected, citing higher medical costs. That's been a theme with the insurers. And then Novo Nordisk shares on pace for one of their worst days on record. Let's get to Angelica Peebles with the details on that name in particular, Angelica. It doesn't come out of nowhere because the stock has been on a bumpy ride, but I guess it goes from bad to worse.
Yeah, Sarah, it has definitely been a bumpy ride, but today we are just getting bad news and also an update on the company's CEO. So for the rest of the year, Novo is slashing its full year sales guidance, and they are also announcing a new CEO. Now, first, let's start with the guidance. They're now expecting sales growth of 8 to 14% versus the 13 to 21% that they had previously guided. Now, the street had already been trimming its estimates. Consensus was at 13% sales growth, but clearly those estimates had not come down enough. And so that just speaks to some concerns, some weakness that they see for the rest of the year. Now, on the new CEO, that CEO is Mike Dustar. He's currently the head of international operations at Novo, and he had a chance to address investors this morning. Here's what he had to say.
The fact that my announcement comes right after the guidance update, well, it just makes the mandate ahead even more clear. We need to increase the sense of urgency and execute differently. But we'll do that by building on the core strength that makes this company so unique.
So the question here, though, is why would they promote someone from within, especially someone who comes from the international business, when today Novo is saying that the U.S. is really at the root of their problems. And so just now on a media call, I had a chance to ask both the new CEO as well as the chair of the board, why are you the right person? Why is he the right person right now? And the chair of the board, Helge Lund, said that Mike is an exceptional leader with a track record, and he points to his ability to build high-performing teams, and he also has broad commercial experience around the world, and he does have experience in the U.S. And Mike himself did say that just because he led international markets, that doesn't mean that he doesn't have experience with the U.S. He's sat on this executive management committee, and that has given him insight into the U.S. So he talked about some of his different priorities. His top 3 priorities are deepening Novo's leadership in diabetes and obesity, and also sharpening the commercial execution, as well as realigning the cost base. So he has a big task in front of him, and this is just what we're hearing so far, guys.
What happened here, Angelica? How did Lilly and Novo, who dominated this space, Novo, who practically had the Kleenex of GLP-1s with Ozempic, how did it turn so south?
Well, there's a few things going on here, and Lilly is definitely a strong competitor, and their drug tirzepatide, remember, that's both Mounjaro and Zepbound. That is a better drug. It helps lead to more weight loss, and they have been gaining share consistently in this market. At the same time, you have this compounding. And that's what Novo is saying today is really the source of the problems that they see for the rest of the year. They estimate that compounding represents about 1/3 of the market for GLP-1s, and that they thought this market would go away when the FDA said it would start enforcing this, so-called ban on compounding, but that hasn't happened. And they say that their market research shows that compounding is still a formidable threat, and that is something that they are going to have to contend with. And so, whether they just didn't see it coming, that's an open question. But at the same time, now they have all of these fronts that they're dealing with. They have Lilly to deal with, they have the compounders, and they have questions about their pipeline and whether they are set up for success, just not for the next few years, but for the coming decade, guys.
Yeah, stunning to watch. And look at that longer-term chart there in terms of the ascent and, of course, this decline. Angelica, thank you. Let's get a news update now with Savannah now. Savannah.
Hey, David, good morning. Well, New York City's mayor said this morning that the man who killed 4 people Monday night in a Park Avenue office building in Manhattan may have been targeting the National Football League headquarters. Eric Adams said today Shane Tamora talked about the brain disease CTE, though he was not an NFL player. Sources tell NBC News he left a 3-page note, including several references to the condition, which is often associated with football players and other athletes. Now, among the victims, an off-duty New York City police officer who was working a corporate security detail. Police identify the officer as Didarul Islam, an immigrant from Bangladesh who leaves behind 2 young sons and his wife, who is pregnant with their 3rd child. And investment giant Blackstone confirmed today one of its senior executives was also killed. The company said in a statement, Wesley Lepatner embodied the best of Blackstone and shared prayers for her husband, children, and family. According to Blackstone's website, Lepatner was a Yale graduate who joined the company in 2014 from Goldman Sachs. Sarah.
I know a bunch of people that are very close with her, and she was a rock star. It's so sad, leaving behind 2 children. Thank you, Silvana.
Yeah.
She valued member of her community, of the Jewish community, I think of Blackstone, where she was a rising star in that real estate business, and it's just devastating, the randomness of life.
Our thoughts are with the folks at Blackstone today. Squawk on the Street's back after this.
Some mixed reads on the consumer today. New consumer confidence data at the top of the hour topped expectations. But executives from Whirlpool, Procter & Gamble calling out a pressured consumer on their calls, while Royal Caribbean shares are falling despite saying bookings have accelerated since last quarter. Joining us now with his top consumer picks is Neuberger Berman portfolio manager John San Marco. It's great to have you, John. So how do you navigate what seems like a little bit of a fractured consumer environment? Pressure at the low end, high end remains strong, confidence comes back.
Good morning. Thanks for having me on. I think that's a great setup. I think, there's a lot of mixed data out there that I would characterize as the consumer being in somewhat of a fragile condition. You saw the confidence data improve sequentially. There's some encouraging stuff in there, like their thoughts around inflation and the job market, but it's still down. It's still depressed by historical standards. So I think, we're one additional shock away, one confidence shock away from the consumer retrenching again. But, I'd characterize the condition as okay. There are some opportunities for some winners within that backdrop.
Like what? What do you like right now?
We really like O'Reilly Auto Parts. We think it's a great way to play defense with growth. It's it's the leader within auto parts retail, which is from my perspective the most tariff insulated area of retail. Pricing power there is not infinite, but they compete mostly on service, on speed of delivery, on parts availability. All areas they're winning and winning more today than they were a year ago. So, we think whatever happens with tariffs and the consumer health, they ought to be well positioned. Home Depot is another name, perhaps more on the cyclical side. The market is pricing, what is a stubbornly depressed housing activity market. But I'd note that we exited 2022 with 7% mortgage rates and existing home sales around 4 million units. That's about where we are today, almost 3 years later. So some of that lagged impact on industry demand has been depressed, and then on the company specific side, they've executed exceptionally well, set up very well for when the cycle turns.
I was going to say, but we've been waiting for the cycle to turn for a while now, and that doesn't necessarily happen. It has to happen for Home Depot to work, doesn't it?
The cycle has been painfully stubborn, and that's fair in some respects. Not to be too Pollyanna, I think it's so bad it's good. The more home projects that are getting deferred now, the more home projects that will are getting pent up, and we will get those eventually. But to your point, for sure, to sit here and hold the stock should this cycle sort of persistently never come, that is the risk to the stock. I think that's very well discounted, and I think there's enough company specific self-help that they can do. That is certainly as we move into the back half of 25. I think your downside case is the status quo, that the business is back to sort of eking out modest growth, and my base case would be that you get a little cyclical help and those kickers that from all the work they've done around M&A and self-improvement.
John, a couple of questions about beauty, given sort of the upturn in Ulta and the repair work that EL's been working on. What's behind that? How much is left to go? And is that a comment about some kind of consumer resiliency?
Yeah, as perhaps like taking a step back, what I really like about Ulta that I think is unique to the beauty category is as a house of brands where you can get all brands, all categories, prestige and mass. That's a unique positioning. I think this is one of the few retail verticals where the bargaining power is within the distribution, because consumers want to come there and try and shop across all these price points. So I like Ulta's right to win. Now that said, we're coming out of a year where they were, I think, arguably rightfully left for dead by the market. Competition was proliferating. As you pointed out, the category had its own troubles and it had slowed back down to earth. And then they had just myriad self-inflicted operational wounds. And fast forward to today, there's a new team in place. Execution is visibly better. In last year's most troublesome competitors have either plateaued or paused or in some cases retrenched. So, I think the category I would expect to be somewhere around stable, but I think Ulta's performance within that category I think they'll start to demonstrate their right to win in what secularly is a very attractive category.
Well, John, the market overall has sort of applauded the clarity on the trade deals, and companies across the board seem resilient. Different case, what I hear in the consumer sector and in retail in particular. I mean, a deal like Vietnam, for instance, that the president announced with 20% tariffs and 40% transshipments. What does that do to U.S. retailers, and who's most exposed?
Yeah, a really interesting and difficult question. On one hand, retail is sort of coming out of the tunnel. They were just starting to see the light at the end of the tunnel. On the other hand, your question really highly focused on tariffs. Obviously, no sector of the consumer economy is more impacted than the retailers of goods. So it's sort of a mixed bag. As a result, I'll hedge myself a little bit to say my expectation is that I think in the near term, the consumer and retail has fewer tailwinds than sitting here today than it did coming into the year. So I think the next move is a little bit slower, a little bit of consumption slowdown in retail before we get to 2026, and perhaps there's some stimulative effects from the tax bill that are helpful. But the biggest of which is obviously tariffs. I mean, the consumer data we're all looking at today that is coincident is showing us how the consumer is behaving, and they're just getting the first or second inning of some of the price pass through from tariffs. So as that heats up,
you think it's coming in a big way?
I wouldn't want to overly dramatize it. I think it's coming in a bigger way next month than today, and a bigger way than that in a few months. And I think you could see the consumer stumble a little bit and pull back in some discretionary pockets, but nothing. The consumer's balance sheet and current job performance and real wages are good enough to weather the storm, but perhaps weather the storm less good prospectively than retrospectively.
All right. Well, thank you for joining us with all the commentary, John Sammarco from Neuberger Berman.
Thanks.
It's good to see you.
Thanks.
When we return, AstraZeneca CEO breaking down the quarter, plus his expectations for tariffs and whether or not the company's looking to relocate to the U.S. Later on, don't miss the CEO of SoFi, Anthony Noto, as that stock goes to almost a 4-year high today. We're back in just a moment.
AC Plus.
Hints of the busiest week of earnings season are upon us. Microsoft and Meta Platforms reporting their results tomorrow. One trader is taking a look at the setup for big tech and thinks we could see fireworks and an opportunity to profit. Tune into our Market Navigator segment later on today on Power Lunch for more on those strategies, 2 p.m. Eastern Time.
AstraZeneca beating second quarter revenue and profit expectations, citing robust sales of newer cancer, heart, and kidney disease medicines. I did speak with the CEO about the quarter. Any expected tariff impact on pricing, weight loss drugs as well? I also asked about the company's recently announced $50 billion investment to expand manufacturing and research here in the U.S. Listen.
The innovation in this country is tremendous. The U.S. is leading the world in biopharmaceutical innovation. And I think this is really fundamental. It's fundamental to U.S. patients. It's fundamental to the U.S. economy. Why? First of all, for patients, technologies are exploding. Science is rapidly improving. When I started in my career, we were selling pills. Today, we have so many different technologies. The day when we can cure diseases that are seen to be incurable today, that day is not far away. And it is happening because of the science that is taking place in this country. So great science, we want to partner with that great science. And the second, of course, is a big country, big population. People need our medicines so we can keep them healthy longer. The battle, I think, is still too much about keep dealing with disease and keeping people a little bit longer, but not necessarily healthy. I think the future has to be to diagnose, screen and diagnose people early and keep them healthy longer. So that's really what our industry should be focusing on.
On tariffs, I'm curious what you make of the new framework of the EU deal that has been announced and the fact that it appears that pharmaceuticals will have to have a 15% tariff when shipped into the United States. How does that affect you and what do you think about it?
Yeah, it's a great question, and I'm sure you're going to get different responses from different companies. As it relates to our company, we took the decision several years ago to invest in different geographies to supply those geographies locally. And, that was reinforced by what happened during the COVID period. We realized that the direction we were heading into to localize manufacturing was the right one, and we accelerated it. So we now have 11 sites in the U.S. As I said, we just have announced a multi-billion-dollar new manufacturing state-of-the-art site in Virginia. So mostly we are self-sufficient to manufacture our products for American patients. There's a couple of products that are still made in Europe, and but we have the capacity to manufacture them in the U.S. and we are rapidly shifting them. As soon as we have the regulatory clearance for that, they will be made in the U.S. and will be self-sufficient. So that doesn't really affect us, those tariffs.
Mm-hmm. Do you think broadly, though, and I know you're relatively insulated, as you just laid out, but broadly, do you think it'll raise the cost of medicines in this country, in the U.S.?
Well, it might raise the cost of some medicines. It depends. Again, every company will be in a different place. If you actually happen to manufacture in the U.S. for the U.S., which we do, there's no need to increase price because of tariffs. We manufacture in China for Chinese patients, and we export a little bit from China to emerging markets. We manufacture in Europe. So in the U.S., if you manufacture locally, There's no reason for an increase in tariffs unless there is indirect pressure of those tariffs on other aspects of your manufacturing. But I don't expect, in our case, that it would create substantial price increases because we are self-sufficient here in the U.S. to manufacture our products.
There have been reports recently that you're considering relisting in the U.S. instead of in London. Is that true?
We never comment on rumors, as you would imagine. We've had so many rumors over the years. So, no, we don't comment on this rumor. I will leave it at that. I will only say that, again, we feel very American as a company. We have almost 20,000 employees in this country. We have two large we have two large R&D centers. We have 11 sites, manufacturing sites. It's a very important country. We're American.
And finally, on obesity, there's a lot of interest, obviously, in the GLP-1s. I know you're interested in this space. How do you see yourself playing and competing against some of these first movers?
We have, we've followed our mantra, if we want. And our mantra is to follow the science, of course, but also to bring our medicines to as many people as possible around the world. And in that context, we decided to go the oral route. So we have an oral GLP-1, and we have other agents that are oral agents for hypertension, for cholesterol management. And so we have an oral agent that is progressing through clinical trials. And we've gone that route because we believe an oral agent is easier to take. It will be possible to price it at a more affordable level than an injectable product. And so we are going to be able to bring it to many more patients outside the U.S. Because outside of the U.S., as you probably know, access is always an issue. Cost is an even bigger issue outside of the U.S. than in the U.S. So we believe an oral agent will be more affordable, and we can bring it to so many people around the world.
Looking to create that more affordable option on obesity drugs. And the conversation on tariffs is important for the pharma industry because guess what? Pharmaceuticals were the #1 export of Europe to the United States last year, almost $100 billion worth. It represents about a quarter of all European exports to the U.S. Right now, what EU is saying is that in this new deal, it actually stays at 0 tariffs, subject to the results of the 232 investigation, which the Trump administration has done on pharmaceuticals like semiconductors, national security implications. But the assumption is that they will go up to 15%, which will be a big deal for when we import medicine from Europe.
Indeed. Ed Lutnick said today, another couple of weeks before we learn more about the tariff levels on that particular sector. In just a couple of minutes, our stock's overvalued, what the street is saying, according to the results of our latest Fed survey. And then check out Sarepta. Didn't quite get to it today as we go to break. It's a name we've been following closely. It is surging after the company said it would indeed resume shipments of Elevidys for muscular dystrophy. Be right back.
CNBC out with its latest Fed survey showing some growing concern about the market's valuation. Let's go over to Steve Leisman. He's got details for us. Steve.
Hey, David. Yeah, respondents to the CNBC Fed survey expressing as much concern about overvaluation in the stock market as they have in at least a year. S&P seen pretty much flat, even down, according to the average respondent. 37 respondents this time. 6344 was 6133 in June, so it's up from there, but below where the market is right now. A good gain expected for next year, with a 9% gain from the current level, up to 6936. Significantly overpriced, though. 14% say that's the case, and 70% say it's at least somewhat overpriced. Add them two together, that's 84%. Just 16% say the market is correctly priced. That is the highest level of concern about overvaluation that we've seen in about a year. One offset, though, could be what the Fed does. The rate outlook sees 2 cuts priced in for this year, 2 for next year, for about 1 percentage point in cuts expected through 2026. But note here, the expectation is for little relief on the long end. The 10-year is seen ending the year at 436, about where it is now, and just a little bit of a decline expected through 2026, 425. So 100 of cuts on the overnight, but not much on the 10-year. Enabling the Fed to cut, though, is the growing belief that tariffs will end up being one-time price hikes. That's the view of 51% of our respondents, up from 43% in June, and 27% see it as a road to broader inflation. No change expected at this meeting this month, but 65% see a cut in September. That belief comes along with growing certainty about the impact of tariffs. It's the number one risk to the economic expansion. Guys?
So do you think we'll hear a little bit of a tone change from Powell this week? A little more amenable to cutting rates because the inflation numbers have been more benign?
It could be, but it also depends on the horse trading that goes on with the statement, Sarah. As you know, we'll see if he does tee up a September rate cut as the market expects.
Steve, we'll see what we get tomorrow. Thanks a lot, Steve Leisman, this morning. As we lose a little steam here, but again, an extremely tight range on the S&P, just south of 6,400. Still to come next hour, the CEOs of SoFi and Cisco, following results out of both names when Money Movers begins in just a minute.
CNBC Plus.
For certain. Now we are encountering this old. Perhaps a small amount of divergence here, making corresponding highs along with price here. So once again, look for a breakdown in that indicator along with price drifting below some important technical levels here. When we look at volume profile and standard deviation channels, we can see here this level, our red line here matching up with that post gap down high. That is a standout volume area. So around 192 would be another extra emphasis on this area. If we were to look up ahead, though, to filling the gap, our +2 standard deviation channel, 2 standard deviations up from our linear regression line, our line of best fit, matches up really closely with that gap level. So that could be an important area to watch if we do get some kind of upside breakout here. Finally, another smaller node here comes in around 185, another downside level that sticks out.
All right. Thank you, Rick and Jessica. Thank you both for a look across the big three today. 3 stocks, 3 charts, 3 tickers today. Thank you, guys. All right. And then welcome back to Trading 360, or you're still here with us on Trading 360. Time now to spotlight this week's Fed meeting. It is underway beginning today, ending tomorrow. Joining us for perspective on what to expect, we've got Terry Wiseman, Global FX Rate Strategies at Macquarie. Terry, thank you so much for joining us today. Let's talk a little bit about expectations. We appreciate it so much. So I just looked at the CME Fed Watch tool. The expectation, as I expected, is still that consensus is we're not going to get a cut for this meeting, although the pressure has been on. What do you think we are going to see as the outcome in terms of signaling?
Well, I think the most significant thing that we might see are dissents from prospectively 2 governors on the board of the Federal Reserve. That would be Michelle Bowman potentially and Chris Waller potentially. I'm not saying we're going to get 2 dissents. We may get 1, but we may get a dissent, 1 or 2, and that would be the most significant thing. I think what we're going to see, if we were in that meeting room today, you would see a robust debate about the outlook for the U.S. economy. The doves are not in the majority. I think the people who are cautious, or you could label them hawkish, if you will, in this context, are in the majority. But there will still be a robust debate. I think the doves are going to argue rightfully that there are pockets of weakness in the U.S. economy, with the consumer, with housing, with hiring in the private sector. I think those are things that they can easily point to if they wanted to make a case for cutting. The majority is not going to listen, of course. They're going to do what they want to do, and they're going to keep rates on hold. But I think this robust debate could be setting the stage for a cut later this year. Of course, the market is starting to place a bet on September for that first cut. I can't easily disagree with that. All right, it is a meeting in which there will be a new summary of economic projections. There'll be new dots. It seems like either September or December would be the right time for the Fed to start cutting.
Terry, let me ask you this in terms of posture, right? What are you expecting? I think investors, economists, et cetera, are going to be paying attention to Fed Chair Jerome Powell's tone in the press conference. Recently, it was obviously a completely different subject when the president was over at the Fed, and they got kind of testy with each other over the cost of that construction, right? What are you expecting in terms of tone?
I think the tone from Jay Powell is going to be one whereby he emphasizes that political considerations are not figuring at all into his decision making, and hopefully not into the decision making of other FOMC members. I think Jay Powell knows that he's on the way out next spring. I think that he wants his legacy to be one whereby he held true to the operating principles of the Federal Reserve and the integrity of its dual mandate. That is trying to ensure that you keep politics out of the way when you move policy towards attainment of the price stability goal and the maximum employment goal. I think that's what he's going to emphasize. There really isn't a way or I think a willingness on his part to allow into the decision-making process the influence of politics. Now, having said that, like I said earlier, what he can admit is the prospect that we will see some cuts later this year. He would do that potentially by hinting at those weak spots in the economy that other FOMC members are pointing to. He'll say that the time is not ripe yet. He'll say that there may be still some uncertainty as it pertains to the trade outlook and the inflation expectations outlook, but he could say something to the effect whereby if things progress the way that he expects them to, a rate cut could take place later this year. I think that's how he would convey that without needing to invoke the political pressure, the legal pressure on him right now.
That does sound like the way you're expressing it sounds like the cadence of how he speaks. So you're not alone, obviously, in that view of a September cut, right? The odds are increasing right now. The odds are at more than 60% right now. What do you think pushes the Fed to cut then sooner, essentially, rather than later, rather than kicking the can down to December? Is it about, consumer spending? Is it about what the job market looks like?
Right, and I want to emphasize, I'm not certain that they will do a September cut. It could still be a December cut, but I think the criteria are generally the same as we approach the prospect of that cut. There could be a mild increase in the unemployment rate towards 4.3 or 4.4% on the back of poorer hiring. We know that CEO surveys, for example, are downbeat on the outlook for hiring, so that could do it. Or we could conceivably see lower wage inflation pressure. Instead of that year-over-year number of 2.9, any decline to 2.8 or 2.7 on an annualized basis could do the trick and suppress concerns about inflation. It could be, and this is very important, just more certainty on the trade and tariff outlook. Remember that Jay Powell's best excuse and most often used excuse for not cutting yet, despite the signs of weakness in the economy, has been the uncertainty over tariffs and whether that uncertainty will manifest itself in ultimately higher inflation expectations. I think that now we have a few of these so-called trade deals happening and getting locked in, that will be one less excuse for him to use. So that certainly progress on trade, at least in respect of getting these deals done, is another potential trigger for that rate cut.
Is that what underscores your view? And I love the way you put this in your note that the U.S. and its allies, especially as it relates to trade policy, are in marriage counseling rather than divorce.
Well, yes. I use that expression because if you recall, if you go back to February with the infamous speech by J.D. Vance to our European allies, it seemed to suggest that the U.S. was intending to sue the EU for divorce. What he was saying effectively is that the strategic alliance and strategic cooperation would no longer be taking place. I think that was, if you looked at the world that way back in February, you were probably exaggerating and overly pessimistic. I think what we have seen in the last few weeks is at least a willingness on the part of the U.S. administration to re-engage. That's evident from all of the trade deals we're doing, but it's also evident from the nuances in those trade deals. The fact that the Europeans are committing to buying more U.S. energy, the fact that the Japanese are willing to invest more in the U.S., as are the Europeans, in effect, seems to be a strengthening of the strategic alliance, not a weakening of it. And it's one reason, of course, why the markets have been getting, I should say, a little less concerned about that divorce scenario and understand that this is still a situation where both sides are talking and trying to talk through their feelings.
All right, Terry. Thank you so much. That's Terry Wiseman, Global FX Rate Strategist at Macquarie Group. Thank you. Coming up next, the disruptors will cover SoFi. That stock rallying to 4-year highs today off the back of its quarterly report card. That's next on Trading 360. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of think or swim. the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Trading 360. I'm Diane King Hall, live from the New York Stock Exchange. We're looking at stocks on the move. I want to bring in Schwab network contributor Sam Vadas. We're taking a look at Novo Nordisk. That stock sinking today. When I first glanced at it, as I mentioned to you before, I was like, is this a full year move? Wow.
You had to do a bit of a double take there. As you can see, it is down about 21% in trade this morning. And this coming off the back of guidance. It seems to have disappointed the street this morning. So it's now talking about a full year 2025 sales outlook of between 18 and 14%, which is well below the 13 to 21% that it had previously been talking about. So quite a significant drawdown here. And this is to do with some of its thoughts around the reduction in some of its expectations on Ozempic and Wegovy weight loss drugs, lower penetration in international markets, no doubt rising competition from the other traditional pharma companies, but also some of the copycats, the knockoffs that has challenged this business. They have talked about competitors selling cheaper alternatives or copies of their drugs. They're obviously not happy about that, no doubt creating a lot of uncertainty. But let's talk about this stock because it has been on a downward trajectory, which is certainly interesting, Diane, because we have been so used to the growth trajectory story of a company like this. So it looks like the knockoffs have knocked it off its perch somewhat, down 40% at year to date. Interesting because obviously we've been tracking the competition from the folks over at Eli Lilly, but even if you take a look at that stock today, it is also down, not in such high double digits, but it is certainly down. The big question, though, as I've been sort of poring over some of the analyst commentary and the media reporting around this today, is what we're seeing today an overreaction or a bit of a red flag here off the back of this outlook? Now, there has been some suggestion and a view out there that perhaps the stock and the reaction here is an overreaction, and that is because there is demand for the GLP-1s and there is hope that there will be regulation around some of the knockoffs that will inevitably help this company. So surprise surprise double announcement, I should say, also because they have again made a sort of simultaneous announcement on a new CEO bringing in the head of international. So this is someone who is internal, but they do have experience in the US market. So they're trying to reassure investors here about that. But this obviously coming off the back of weaker guidance. No doubt this new CEO has a lot of work to do, Diane. But, you know, positioning, as I mentioned, it's been a favorite in the space because it really has been seen as a leader in the GLP-1 space, you know, particularly when it comes to market share. But the lowering of the sales growth, no doubt disappointing investors. And to add to that, I mean, you and I were talking about UNH this morning. It's just not been a very good time for the whole pharmaceutical industry as a whole, you know, when you look at the healthcare space with regard to headline risk.
Yeah, and to your point, that knock-on effect happening, you notice it in Eli Lilly and even Hims, where you have the dupes. All right, thank you, Sam. That's Sam Vadas, Schwab, a network contributor with the latest look across Novo Nordisk. Time now for the disruptors. Joining us with today's company is George Sillis, senior markets correspondent. We're taking a look at SoFi. This stock is rallying up more than 12% off the back of its latest quarterly results. What were some of your takeaways here, George?
Well, the report was actually quite good for SoFi. I mean, this has been a really big turnaround story for the company, which really originated as a student loan business, but now it's effectively expanded quite aggressively into things like insurance, credit cards, personal loans, brokerage, crypto trading, and all sorts of financial management investments. And of course, the bank charter that they secured also allows them to bring in deposits and of course make personal loans. And it's become a very popular brand from the standpoint of digital banking. And overall, the stock had been challenged for the last year or so, irrespective of the last 6 months, which a lot of the financials are moving higher because of the Federal Reserve maintaining high interest rates. This brand has been growing quite aggressively, not just in popularity and, of course, the number of users, but also from a profitability and top line sales standpoint. They reported an adjusted EPS of 8 cents. It beat the estimate, which was 6 cents. That was 81% higher than last year. If you look at top line sales for the quarter, they were higher by 44% at $858 million versus $805 million expected. But if you look at the compositional breakdown, total lending increased by about 30%. They also talked about financial services growth, which actually increased about 106%, as well as fee revenue higher by 72%. And of course, product revenue also higher by 34%. But they also increased the guidance for both EPS as well as revenue on an adjusted basis for the remainder of fiscal year 2025. And really nice move to the upside as a result of these numbers.
Yeah, certainly. And even before today's move, that stock was an outperformer compared to the S&P 500 year to date, or even significantly year over year. So then given its performance, given how it's done in this most recent quarter, what's your approach for an example trade, George?
Okay, so this one, Diane, is very fickle because I've watched this stock trade post earnings for a long time. And in fact, one of the things I noticed is if you see today's high, which is around a little bit more than $25, and you zoom out, that goes back to a 5-year level. And so I think that's going to be a barrier, at least in the short term, that $25 area. The other thing is you'll notice today, it's gapping higher on a daily basis, and the low of the day is around 23. So what I'm going to do is I'm going to structure a bullish trade, but I'm also going to take into consideration that the stock may end up being in a trading range for a little while. So we're actually going to structure so we harvest some yield on this as well. So instead of just buying an outright call option for the $23 strike, that'll cost you about $250. I'm going to structure a long synthetic combo. So I'm going to buy the $23 call. These are August monthlies, by the way. And I'm also going to sell the $23 put to help harvest some credit to offset the expense of that $23 call. So altogether, earlier today, you could have structured this trade for about $1.25 debit or $125 a contract. So in essence, the break even on this trade is 24.25 by expiration in 52 days. It has unlimited profit potential, so it's unrestrained to the upside. But you have to be mindful that if the stock does trade below 23, you'll be assigned shares. It's 100 shares per contract if you do structure this trade. But your cost basis is still 24.25. So it's a bullish trade, but that short put allows us to harvest some yield just in case the stock ends up going in a trading range or trading in a trading range until it sort of digests these earnings and decides if it wants to break out of that $25 5-year barrier.
Okay, all right. That's an example trade there for Spotify. Bullish is the view there, like the momentum that we're seeing today. Thank you, George. Coming up next, time for our 360 round. We'll discuss the latest look at Boeing after reporting its second quarter results. Trade 360. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you
The revenue coming in at $22.7 billion, more than 30% jump on a year-over-year basis. Their cash burn improved as well. Noah, what's your reaction to their results first?
It's great news. It's a nice turnaround, heading in the right direction. As they said on the earnings call, more room for improvement, need to turn the loss into a profit, but really great news for investors.
Okay, Melissa, what's your take on those results?
I really liked it. It looked great in the pre-market, but right now, to be honest with you, it looks absolutely terrible. It has dropped almost 20 points since where it was in the pre-market. There's a possibility of a strike, a union strike that could go into next week. That doesn't look good. And considering the fact that it was up this morning so much on earnings, considering it had the tariff reprieve with the European Union, it absolutely should have held strong today, rallied today, held at least at a bare minimum over 235. And it looks like it's just going to continue falling into the close today. And again, if the market sells off today, tomorrow, the market's been falling too, then this could break 220. And then it's nowhere near where it was this morning. So I did really like it this morning, but it's not holding up on the day.
So that's a great point, Melissa. But, you know, this is a one-day move. Noah, do you think that's meaningful, the fact that it didn't hold up compared to how it performed in the pre-market?
It's meaningful, as she points out. It's a pretty meaningful decline for this kind of company, right? But what I would point out is, you know, it wasn't in April. This was in the upper 140s, right? Trading now at 227. So maybe for short-term traders in what was expected to be nice earnings, cashing out could make some sense. It is a healthy decline at roughly 3.5% right this second. But that's what I'm attributing it to, is more maybe short-term trading today, getting that news. But I do think there's some tailwinds coming, right? She mentioned some headwinds in terms of a potential strike, but if we are also getting into a lower interest rate environment, this could be one of the stocks that would improve nicely based on news like that.
Okay, Melissa, let me ask you this. Kelly Ortberg calling 2025 Boeing's turnaround year. Still, obviously, there's still a loss that it's reporting and wants to get to a profit by the end of this year. How much patience does Wall Street have for its turnaround year?
For some of these stocks that have been underperforming while the market has been blazing, skyrocketing out to brand new all-time highs almost every single day that we get up in the morning. So again, if you look at Boeing, we have one more earnings after this. That's it. Then the year is over. So, I mean, we have less than 6 months to the end of the year, one more earnings season. Market made brand new all-time highs today, and Boeing is nowhere near the highs. Last time this stock was at brand new all-time highs, was over 400, was 2019. It's nowhere near this. And again, if it drops all the way down to 220, breaks 220, it's in danger of getting to 200. And then it's 50%, more than 50% off the previous highs, which was, again, 6 years ago. When you have a stock like this that is such a big component of the Dow, which I don't always trade the DIA, which is the ETF for the Dow. I usually watch the SPY and the QQQs. But when you have something like such a big component like this, it's nowhere trading where the normal ETF is, you have to wonder what is going on. What is the problems? I'm not saying the stock never recovers. I'm not saying this at all. But to think that it's going to recover between now and the end of the year, when it's got one more earnings season left, and it had lots of chances today to do it. Again, with the tariff reprieve, I just don't know if that's possible.
But to be fair, even with today's move, it's been an outperformer compared to the S&P 500 year to date. And Noah, we talked about, you know, the cash burn improving significantly. I mean, from 2.3 billion, which was massive, to just 200 million. Is that enough to change the narrative for institutional investors, Noah?
I think so, if they keep heading in the right direction, right? Again, not counting some potential issues, but also potential opportunities ahead. But yes, if they keep on this trajectory, I think you can continue to see this stock possibly outperform the S&P as we get out to the end of the year. Again, that's sort of based on what we know today. They got good news on tariffs, probably interest rates going their way. If they can manage some of their company challenges, as they appear to have been, I like this stock going into the end of the year.
All right. Thank you, Noah. That's Noah Hammond, founder and CEO of Advisor Shares, and Melissa Armo of the Stock Swoosh. Thank you so much, both of you. Thank you for joining us today on Trading 360. I'm Diane King Hall. Download the free Schwab Network app. It is available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. Fast Market is up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network. And welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today. We'll discuss markets, which are off of session highs, and then we'll have some option strategies. We're going to cover Visa, which is up about 12% so far this year into their earnings, and Starbucks, which is still in bear market territory, into their quarterly report this afternoon. And then, like Folio, we'll have sentiment data in Mondelez, which is up about 29% off its recent lows into earnings after the closing bell. Now let's take a look at the major indices, which, as I mentioned, off of those session highs. The S&P 500 down 0.16%. The Dow Industrials off nearly 200 points, or just over 0.4%. NASDAQ still holding on to green territory, slightly positive, and the Russell 2000 small caps down nearly 0.5% in today's session. To help me break all this down, let's bring in my co-host. That's Kevin Hinks. Kevin, give me your take here a little bit of, the storm has started, I guess, as far as earnings goes this morning. A lot of data this morning, but we're kind of just floating nowhere, kind of like what happened yesterday, even though the S&P 500 and the NASDAQ 100 both settled at record highs yesterday.
Yeah, Tom, there's breaking news right now. The U.S.-China discussions have just ended. They agreed to extend the trade truce. So that's breaking right now as we're coming on the air. So let's see how the markets react to something like that, although that's pretty much expected. Besides that, kind of a bumpy day here. I mean, a lot of stocks that came out with, at least the chance for a relief rally or good earnings, like in Boeing, United Healthcare, all down, and Spotify. There's a couple names getting hit today on their news of their earnings. So let's see if that's setting a tone for earnings season. The data is getting hit today
the data, we got a
on
lot
their
of it.
news of their sure any of it's that significant. Consumer confidence upticked 2 points. The JOLTS was about in line, just a little over 7.4 million, pretty much where they expected. I don't know, besides that, it's really the market is digesting a bunch of earnings and figuring out that they're not real thrilled about them, Tom. That's what it seems to me, because Boeing's was, fairly positive. Stock's down. United Healthcare, new CEO talking about better things in the future, stock down. Spotify, stock down there. So, we're, again, Tom, this is one of those situations where we're going to get a ton of information. Which is affecting the market more? I don't know. Could be all of them, could be some of them. But, the market's down less than 0.2% off the highs that it opened this morning. I don't know, Tom. It seems like a little bit of it could be just a little ebb and flow here in the market, trying to get a hold of it. But so far, it just feels like a little bit more earnings disappointment than anything else.
Yeah, China's lead negotiator saying that they're going to pause for 90 days, extend that. They're maintaining communication and will continue to work through a trade deal at this point. Not helping stocks at all. But you mentioned some of those names, Kevin, that reported earnings. PayPal is down 9.5%. That was a pretty good report by them. United Parcel down, UPS down 9.5% here today. Stanley Black & Decker. There's been stocks, and not all these stocks, we talked about it before, Kevin, where the high bar going into earnings, was kind of reflective of the moves that we'd seen post-earnings, was that they would pull back here a little bit. But then you look at, UNH, cutting their guidance moving forward. They've just got trouble after trouble for that company. And then Boeing was up a couple percent in the pre-market and fell, now down over 3%. So it feels like, maybe the euphoria of the month of July starting to wane here as we're wrapping up the month here in the next couple of days, huh?
Yeah, there's just so much, right? That remember, all this we're consuming, all the data, all the earnings, all the headlines. Meanwhile, we're at a 23 PE on the S&P, so we're not cheap. But it is interesting that some of these beat-up names are getting beat up more, like you mentioned, UPS, United Healthcare. Spotify, you can make a case for Spotify, right? It had run a long way. The valuation was getting a little pricey. But what does that mean? If you're a trader, you're looking to tomorrow's trade and Thursday's trade. And what does that give you for large cap tech? Is there going to be any number that's good enough to keep these stocks up? That's what seems to be creeping into my mind. And are we just due for something, a little pause here because of the valuations? We have so much data and earnings still to go this week. We're just dipping our toes in here, and things are already getting a little bumpy. But some big moves here on some of these names.
Yep. And as you mentioned, with the valuations where they are, maybe the move's already been put in after that massive rally that we've seen through May, June, and July for equities at this point. But, to that note, Kevin, even with those some of those individual names getting hammered today post-earnings, the S&P 500 is, 0.1% off its all-time highs. NASDAQ's hitting fresh all-time highs in today's session. You mentioned some of the data that came out, consumer confidence, bouncing back, and that's not surprising. There was some rejiggering from the IMF also this morning that raised their GDP estimates for global growth, the U.S. growth. So those numbers are starting to come in line, probably due to the fact that we're starting to get these trade deals. There's less uncertainty out there moving forward. Is that the outlier here, Kevin, that can maybe sustain this rally, or at least, we were overdue for a pause. So maybe this is that pause and that calm that we need at this point, right?
When you get up to these levels and these valuations, it's going to take a lot to keep the market going higher, and it's probably going to take very little for it to back off. That being said, consumer confidence. I read through the consumer confidence, very closely, up 2 points. The expectations, or the present situation fell 1.5 points, but the expectations index rose 4.5 points. How about this, Tom? Here's something we talk about a lot with these conference board and consumer sentiment numbers. Political affiliation. Confidence improved for Republicans, stayed stable for Democrats and independents. So there you see the divide that you see. That may be muting some of the numbers here. So it's up, but it wasn't up very much in terms of consumer confidence. Let's see. Consumers, how about this? Consumer confidence gained in consumers over 35 years old, Tom. So the young consumers, their confidence didn't go up, but the older consumers did. So, yeah, I like to dig into this information, into the data and see. It looks like the 35 and above are feeling a little better about the economy. The others aren't, Tom.
Yep. Oh, the over 35 crew, that's me for sure. And then tack on some other numbers to that.
No, Tom. You're the way over 35 crew. That's a whole different thing. Way over 35.
Yep. I'm going to leave it there on that one, Kev. We've got the Fed meeting that started this morning. No expectations for a rate cut at this point. We might have some dissenters next, in tomorrow's announcement in the afternoon. Maybe Bowman, maybe another one there. So if you look at this and you look at and you look at the consumer confidence numbers and sentiment numbers are starting to improve. We're getting through that uncertainty, Kevin. I just don't see at this point right now where the Fed's going to be comfortable coming out and saying, okay, we're not cutting this at this meeting tomorrow, but we might signal that we'll start cutting in September when you've got data the way that it is. You mentioned the JOLTS report, basically in line at this point, 1.1 job openings for everybody looking for a position at this point. So it feels like to me, and maybe this is just my opinion, that I just don't see any reason from the data that we have for them to even think about cutting in September at this point if we're starting to see an improvement in growth in some of the data.
Well, yeah, you're right. Here's why I think you're right. I think with the fact that there's no August meeting and there's not a meeting to September is what they're talking about, there's no reason for them to commit to that right now, right? So the market could get very frustrated with a vague response after this meeting. Remember, you've got Jackson Hole. He could guide there. That's another couple of weeks down the road. When you get closer to that number, you'll get more data, so you're not pegged as being wrong when you've got 60 days till the next meeting. Why commit to it now, right? But you could start to say if things get better and if inflation continues to come down and if you can give scenarios like that. But, this Fed likes to see their data, and they don't like to say anything until the data comes out. But if the inflation data, remember, Thursday, Friday, we're going to get two key inflation points, PCE and income and outlays, and wages in payrolls. We're going to get two of them by the end of the week. So that should set a tone for inflation going forward. I think as long as inflation doesn't go back up, you can have a maintenance cut in interest rates. Does he guide to that? Boy, I don't see why he would. I wouldn't pigeonhole myself into that. And the market could get frustrated with his lack of commitment to September, Tom. That's one of the fears out there.
Yep, I agree with you there. We've got bonds up a little bit today. Yields at 10-year yield moving back lower to 4.36% at this point. I mentioned those IMF. They raised their global GDP growth estimate to 2.7% from 2.4%. U.S. GDP growth estimates to 1.7 from 1.5. We get GDP, that first read on Q2 tomorrow, Kevin. That's supposed to show growth of about 2.5%. Maybe we're going to throw that last Q1 number out due to the import skew that we had there. So that'll lend some support to, maybe that possibility that we're not going to get a cut also. But, Kevin, I think everything can change, not only from what the commentary that we're going to get out of the Fed tomorrow afternoon is after the bell. We've got Microsoft and Meta Platforms, releasing earnings, and then Apple, Amazon on Thursday. That's 19% of the S&P 500 right there. We get good numbers out of them. Hey, we could be back off to the races with fresh all-time highs like that, right?
Yes, and remember, they're going to give CapEx numbers. Yeah. Such a key part of their earnings report now is their CapEx numbers. Remember, who came out earlier and raised from 75? Oh, Google Alphabet raised from 75 billion to 85 billion on CapEx spending. You're going to hear a lot about CapEx spending in the next couple of days, Tom, and that will feed into, that's right, NVIDIA, Broadcom, AMD. It could easily feed into those names, but it also gives a message on Microsoft, Meta, Amazon. It'll give a message how they feel going forward. So, yeah, I think CapEx spending is going to be a big number that we're going to hear. And then, of course, digital advertising, right? That's where Meta makes their money. That's where Amazon makes their money. So that's going to be important as well, Tom. So, yeah, we're going to get just a ton of economic metrics that we can consume and digest in the next few days.
Yeah, Kevin, also, if you take a look at so far in the S&P 500, the beat rate's still about 80% at this point. Is that what investors should be focusing on? Because it seems like these valuations are getting stretched on a historical basis for the S&P 500 as a whole, that, hey, you still have to take into context that, hey, are these growth rates going to improve in the second half? Because we all know stocks are forward-looking, and I think that's what everybody's kind of banking on right now is the fact that, hey, you know what, we're going to get through this tariff, headwind that's been created, and you're going to start seeing these GDP numbers start to move higher, where we're actually going to get a reacceleration in some of the numbers from the individual corporations moving forward.
Remember, even in the lowest parts of the first quarter in April, they were talking about the second half of the year and the recovery in the second half of the year. I think a key part of that is housing. Remember, the housing numbers today, pretty benign, pretty depressing, actually, in terms of housing. So housing is such a key part of this economy that's got to get going. How does that get going? Lower interest rates. That's how that gets going. So I just think there's a lot of data that's going to bleed into the overall economy. I think the PCE number is going to be big. Obviously, we get payrolls. Remember, some people are talking about the payroll numbers are getting smaller and they're not as big as they were. Remember, under the Biden administration, the last 12 months, they averaged 41,000 government jobs per month. Since Trump took office, that number is actually negative since he took office. So you're seeing good numbers without any significant government spending at the federal level. So watch for that. And then the wages number, right? Is it going to come in around 3.7 year over year? Let's see. Is the unemployment rate going to tick up to 4.2? Let's see about that. Some of the PCE numbers. The headline is supposed to tick up from 2.3 to 2.5. Again, this is just the consensus. Let's see where the actual numbers come out.
Yep. Lots on the docket over the next couple days, including those earnings from this morning. All right, Kev, let's take a quick break here. When we come back, we're going to take a look at Visa. Credit card stocks is off just about 5% from its all-time highs into their earnings report after the bell. This will give us a good clue on how the consumer's doing during this quarter.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking more earnings. We're going to kick it off here with Visa. Stocks had a pretty good run over the last few years as the consumer remains resilient, but will that continue? Let's bring in Sam Vadas, market contributor here on the network, to help us break this one down. Sam, I think the Visa, MasterCard later this week, they report. This gives us a good indication or some clarity on where the U.S. consumer is at this point, and a global consumer at that. To that point also. So what are your thoughts here on Visa going into earnings? Because even though the stocks pulled back a little bit, the bar's pretty high on this one going into the report.
Hey, Tom. Hey, Kevin. Yeah, absolutely. I mean, we're just a little bit softer heading into this report as far as the shares are concerned, but it has had a good run outperforming the S&P 500. But as far as what it's going to tell us today, you're absolutely right. It is a very good barometer to give us a sense of the overall health of the economy, and it is a particularly critical window into the health of the consumer. So let me run you through the expectations as far as the numbers today. We've got the street forecasting EPS of $2.86 a pop on revenues of $9.87 billion. So the expectation is there for higher profits, and that is thanks to continued consumer spending. Now, it's been very interesting as far as what the data has been telling us, the macro and the micro from some of the earnings report, as to a bit of a mixed picture when it comes to the consumer. If you listen to the Chipotles of the world, if you listen to some of the airlines, they have a few worries about the consumer, but certainly as far as what the banks are thinking, well, they don't seem to be too worried about the consumer. And so maybe that is a bit of a prelude, a bit of a precursor to what we're likely to hear from some of the players in the fintech space. And so that very much is important as far as setting the overall tone and the setup is concerned. But, there are a few things which many analysts, investors are going to be paying attention to as far as some of those consumer trends. Now, how are people feeling about tariffs? Are we seeing some pull forward as far as spending is concerned to get ahead of, what could potentially be some impact from those duties down the pike? People are already, trying to decipher what this means for, whether travel is holding up, whether some of that discretionary spending is holding up. We're getting a few clues from, as I said, some of the companies. It's interesting because, we've also heard another headline today from the folks over at Bloomberg that, top earners are falling behind on credit card and car payments. So that's signaling a little bit of financial stress. So, there are a few moving parts as far as how the consumer is holding up here. But there is an expectation. It's important to highlight that things could potentially slow down in the second half of the year. But this is likely to capture continued strength as far as this quarter is concerned. But, what also makes this earnings report so critical is definitely down to the valuation as well. So the markets, as far as what I'm seeing from the analyst notes, do want to see if we're going to continue to see this impressive growth trajectory while there have been these persistent concerns about the valuation. So this has been really described as the elephant in the room. It's got a significant premium versus its peers. So, we know that the stock has outperformed, as I mentioned. It has been on a good run. But there's also the disruptors to the legacy payments that people are going to be paying attention to. That's been a very big focal point, particularly for the fintech space and some of these traditional payment platforms. Obviously, a lot of investor attention on the stable coins, given the recent legislative wins for that space. Also, a sort of more crypto-friendly environment, that mainstream adoption, institutional investor participation as well. I've been listening to folks over at Mizuho, Dan Dolev, who covers this space. And, while many talk about the disruptors, to the traditional payment platforms from the likes of the crypto industry, the stable coins of the world, and whether they are a threat, there are those who are shorting traditional payment companies because of that. But he believes they are going to be proven wrong. So he's not buying that narrative at the moment. But as far as the broader payment space, Tom, you did mention, of course, as we hear from Visa this afternoon, we will be hearing from MasterCard on Thursday too. So it's going to be, obviously a busy week when it comes to the sort of broader payments space, but, caught up in what is a really big focus on a lot of the tech earnings. But obviously we know that Visa is the bigger of the two here. So a lot of attention on this one this afternoon.
Sam, you mentioned American Express. Their stock sold off a slight amount after their earnings came out, despite talking about a consumer that had bounced back. after April and May weakness. It had bounced back in June, but that stock recovered right back to where it was pre-earnings. You mentioned, the U.S. consumer, airlines a little bit light, but household consumption still strong. We talked about retail sales recovery, and the June number, Bank of America numbers, all showed improvement in June, as you know. So that part should be okay for this company. The threats that you mentioned, are you reading, as I am, that Visa is just talking about putting stable coins, putting crypto into their system and absorbing it into their system, which in my opinion puts out that fire and that risk of anything coming from alternative ways to pay? Why? I mean, as long as Visa and MasterCard later in the week just embraces that, boy, that storm should pass really quickly, like the analyst that you quoted said.
Yeah, it's interesting, isn't it? Because, if you can't beat them, join them sort of thing, if they're going to sort of integrate that into their overall offerings, maybe that is the way to go. I mean, the payments whole industry is facing, a lot of changes right now. And, as people sort of characterize this sort of disruptor type threat coming from the stablecoins industry, I think there's a case where they need to sort of, I guess, as you point out, embrace, mobile payments and some of the digital currencies as well. As far as what we've heard from the others in this space with regards to, what some of the analysts are saying about, the investment thesis here, where sort of Visa sits as far as its position in the whole broader industry. Some of the analysts do express some concerns about the new competition that might nibble at Visa's volumes, particularly in US debit, to which it has a larger exposure than perhaps its peers like MasterCard. But they do say that they have the ability to effectively manage costs and grow margins and earnings, even in macroeconomic downturns. So I suppose that's a reassuring line that's been highlighted from the analysts too with this one.
Yeah, and remember, I think it was 4 or 5 years ago, they said PayPal and Block were going to take over and Visa, MasterCard were going to suffer. That never came to fruition either. And I'm sure the stablecoin, discussion will get embedded somewhere in Visa and MasterCard. All right, great stuff. Thanks to Sam Vadas, market contributor here on the network, breaking down Visa. Kevin, price to sales, price to earnings, price to book, all above 5-year historical averages for Visa, but maybe they should be, Kev, because they continue to grow. Last quarter alone, the cross volume or payment volumes increased about 9%. They expect those to continue. And, do they give better guidance moving forward as we get through the tariff headwinds that, hey, you know what, the consumer's still out there spending when you've got 4.1% unemployment rate at this point?
Let's face it, Tom, in this space of just merely swiping the card, right? Just being the pipeline for the payment. This is such an asset light space. It's such a smooth flow of income and earnings per share. They don't do what American Express does. They don't hold values like that. They are growing and they are consistent and their earnings are smooth. Not a lot of hiccups. Sure. There's some threats every now and then, like, cryptocurrency and stable coins, but I just don't see it as the threat that other people do, Tom. I expect them to keep growing as long as the U.S. consumer stays strong, Tom, and that recovery in June should set them up for a good earnings output. But like I said, they depend on the number of swipes, and they need a healthy U.S. consumer.
Yep. Kev, the option market priced in about a plus or minus $10 move either way in the shares. How do you want to look at this one from an example trade?
Tom, this stock has already sold off $20 off its high. And so I looked at something a little bit in line with the expected move of about $9.90. Let's round that to 10, Tom. I sold this week's 335 put vertical, Tom, collecting about $1.35. Now it's up to about $1.50, Tom. Was about $1.35. So this is a high probability, about 74% probability of finishing out of the money. Tom, this is just a way to take a more passive approach to a stock that's already sold off $20. probably going to put up a good number. And if they do miss, you've got a cushion right in line with the one standard deviation move. High probability, collecting theta, risk defined, Tom.
Yeah, less than 3% move either way expected in this one. So relatively muted implied volatility levels. But let's break this one down. August 1st weekly options, so just 3 days to expiration, really short-term positioning on this example. Sell the out-of-the-money 345 put, buy the 335 strike put, short $10 wide, neutral to bullish put vertical, collecting roughly. We've got $1.35 credit on here. As Kevin mentioned, it's a little bit higher than that. But if you collect $1.35 credit, that's what you can make, $135. And that makes your risk of $865. So your risk reward doesn't look that great, right? Until, as Kevin mentioned, you start looking at that probability of that short 345 strike finishing out of the money. The higher probability means that the risk is going to be a little bit higher on a trade like this, but you still profit in 3 out of 4 scenarios. The stock can go higher, stay where it is, even go lower. It can go against what your thought is on this type of trade, and you can still be profitable as long as it remains above that break even of 343.65 to the downside. So you do have that cushion there on that one. Really short-term example there in Visa. All right, let's take another quick break. When we come back, we're going to be joined by Landon Swan from Likefolio to look at sentiment data in Mondelez. The snack food stocks up about 16% so far in 2025 into their earnings after the closing bell. Stick around.
Trading a
so far in 2025 into their earnings report after. But this is a different beast here with the scale and size of Starbucks, right?
Yeah. It is. I think this is an interesting situation for a company that's a well-recognized name, both domestically and globally. I mean, I think the aspects of what's going on in the United States in terms of things like store traffic or foot traffic, which if you look last quarter, they denoted it was down 4% year over year. Previous quarter, down 8% year over year. So we're coming into a quarter where comps from previous quarters are actually quite a bit to the downside. And even same-store sales in the United States are expected to be down about 2.2% last quarter. They were effectively down, their next quarter they're expected to be still be down about 3%, but they are seeing a turnaround potential coming up into Q4 of this year. So we're sort of at an inflection point, at least right now, in terms of estimated operating leverage for the business, at least in the United States. And of course, you have to include China. There have been challenges for Starbucks in China because of competition between the United States and China. That's really about 60% of the total revenue base. But I think the USA comps have been quite challenging for Starbucks. And I talked with Kevin about one of the up-and-coming competitors, Dutch Bros, that seems to be growing their market share and encroaching on Starbucks's competitive advantage that it had in the past because of the scalability. Now, looking at the quarter, the expected numbers are expected to be quite low compared to where they were last year. For instance, EPS expected to be approximately 65 cents, down 30% compared to the same quarter last year where they generated 93 cents. And then sales are also expected to be a little bit higher to 9.31 billion versus 9.11 billion for the same quarter last year. But that's only higher by about 2%. And I think if you consider the EPS decline rate of change now from last year for the same quarter, that fits the narrative around same-store sales declines, losing some operating leverage, and earnings estimates have been declining. So even, if you look at the last year, the stock is higher by 24%. Year to date, it's relatively flat, slightly higher, around 2.9%. But I did notice the last 3 years, this has really been a serial underperformer compared to the S&P. I mean, the S&P is up about 55 or so percent, just, approximately speaking. But Starbucks is only higher by about 10%. So there seems to be, I think, some growth challenges for the name, competitive challenges both domestically and internationally. There also is, again, some challenges maybe with the U.S. dollar, particularly because the sales overseas are quite large and been growing quite considerably. But even as earnings estimates have been declining, price hasn't really moved much, so that earnings multiple has been expanding. For instance, if you look at the earnings multiple for this year, it's still trading around 38 times. This year's 32 times next year's earnings. Historically, it's around 33 times. So it's really split between this year and next year's earnings multiple. But I think the other thing is you have to consider some of the structural challenges. They're looking at, they launched this recent program called Back to Starbucks. So anytime you have to, market your product and your business saying come back to Starbucks or back to Starbucks to improve loyalty program and marketing and, of course, partnerships, that can take some time. And I think, again, the foot traffic, which was lower last quarter, even down 8% from the Q1 because we're reporting fiscal year Q3's earnings, was down almost 10% going back just 2 quarters ago.
George, my question will be quick. 70% of their revenue comes from mobile and drive-through. Okay.
Yep.
So their average cost per cup $5.24. It feels like they're having an identity crisis. That takes away their in-store, right? If you're buying it a different way.
Yep.
What kind of company is this company turning out to be? They're not fast food, right? Yep. They're not McDonald's. Are they a workspace like a premium coffee shop? I don't know. Not when 70% are coming this way. What's their identity going forward with Brian Niccol?
Well, I think you bring up an excellent fact or issue, Kevin. I mean, I go to Starbucks, and when I look at Starbucks now, it used to be more of a cultural presence, kind of a a social atmosphere where people go. Now I go through the drive-through more, and what I do notice is that the stores look empty, at least the one I go to on a regular basis. But the workers are very busy. So I think the phone in and, of course, the mobile app orders are quite robust. They're getting a lot of productivity out of the workers, but they've got a lot of this square footage that doesn't seem to be utilized as much as far as I can see as in the past. And I think that's indicative of what they demonstrated for foot traffic declines, at least the last 2 quarters, same-store sale comps which are down. And I think there's some underlying challenges from the standpoint of the identity that you mentioned of what Starbucks used to be and what is it now. It's not quite like McDonald's, because McDonald's obviously is just more of a drive-through establishment. But it's losing that I guess that social construct feel of going to a Starbucks and enjoying yourself the way it was in the past. So I think they're going through an identity structural change, and I think that's what we're seeing in terms of the numbers and in terms of stock price performance.
All right, great stuff. A great breakdown for us. That's George Tiller, Senior Markets Correspondent here. Kev, the stock, as we mentioned, relatively flat this year, just up slightly. Option market pricing in about a plus or minus $6 move in the shares. So, I looked at this way. If you think this is like a Brian Niccol turnaround story, a lot of people believe in this CEO because he's done it in the past. This is taking maybe longer. I looked at a strategy that, hey, if you want to hold the shares, maybe collect some yield that pays a 2.63% dividend yield. If they continue to pay that, this strategy takes advantage of it, where you get basically paid to wait on it if the stock doesn't move to the downside too much. So we looked at a covered call strategy, Kevin, where for every 100 shares of stock you buy, you're selling out of the money call. I looked at something a little bit more aggressive, selling the 95 strike call in the August 1st weekly cycle. Sell one of those against every 100 shares of stock that you buy, paying roughly about a $90.40 debit. Probably trading closer to $90.80. Stock has moved up a little bit. But the debit that you pay is going to be your break even to the downside. You're buying the shares at a discount because you created yield, Kev. And then also, you still got a lot of risk, about $9,040 on this one, Kev.
Covered call allows you to still get the dividend and still collect theta, Tom. It's the equivalent of a short put.
Yep, and as you get closer to expiration, you have that opportunity to roll that short option also, but you're capping your gains on that one. All right, that's going to wrap it up for us today here on Fast Market. Stick around, though, right here on the Schwab Network. Next Gen
Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And as we check in on markets here at noon Central in Chicago, we are seeing a relatively quiet session here as we're up modestly in the NASDAQ, Alex, but it does feel like we are talking about how busy of a week this is. Of course, we have trade deadlines on Friday. We have the FOMC meeting kicking off today. We have, earnings galore really starting today after the close. So it does feel like right now we are all holding our breath for the string of catalysts we're expecting for the remainder of this week.
Yeah, and it's really the back half of the week as you talk about. It'll really kick off tomorrow with the Fed press conference at 2:30 Eastern, 1:30 Central. And then it's going to be mega cap earnings after the close tomorrow, mega cap earnings after the close on Thursday, jobs data Friday morning. I don't know that the trade deadline stuff's going to be as big of a headline maker. If it was going to make the headlines, it was today when you got some of this news out of the conversations between the U.S. and China. I'll stand by. You go back to April, it was escalation between those two nations that caused the volatility. It wasn't conversations with Europe or Japan or Mexico or Canada. It was concerns about effective embargo level of trade policy with China because of the reliance for both sides on one another. China to make the things to provide to the market and the U.S. to get things from them, whether it was rare earth or otherwise. And what we found is that reliance has led to conversation, and that conversation has led to extended timeframes. At least that's the news that came out. Scott Bessent most recently did say that the president will have the final call on that extension, but it does seem the market is interpreting the conversation as positive today. So the first of many hurdles this week for the market seems to have been cleared.
Yes. Now, the next leg, I do think, is going to be some of these quarterly numbers because we're seeing some pretty big moves today. Now, not necessarily all to the downside. I know that the markets are broadly lower, but definitely some volatility swings we'll get throughout the next hour. As always, we will kick things off with some of these movers to keep on your radar. We will also be previewing Seagate as well as Starbucks ahead of their quarterly numbers, which are due out after the close, as well as discussing today a pretty blistering move in Spotify, pacing for its worst day in roughly 2 years after a subscriber miss and overwhelmingly results that clearly disappointed, as well as some of the weakness we are seeing today now in other areas of the market, like Novo Nordisk selling off today after giving some disappointing guide for the remainder of this year, as well as Sarepta ending on a positive note, as this name is seeing a huge movement to the upside a day after the FDA said the company could be lifting this voluntary pause on shipments of one of its very influential and important drugs. So a wide variety, but some big swings might be our theme today.
Yeah, no doubt. You want to get into some of these movers, next-gen favorites, SoFi. Again, I'm just shocked to see the 20 handle, and now we're mid-20s in this stocks. It jumps again a healthy 13.5% today. Numbers aside, just impressed that they were actually able to deliver something that was exciting for the street. This hasn't been a market that has been super willing lately to reward upside. As you talked about, we'll talk about more with Spotify later on. It's been a market through the earnings so far that's really just been about punishing. And so SoFi rather is bucking that trend a little bit.
It absolutely is. And it even has pulled back 5% from its session highs, which were a record high, as we did touch $25 a share roughly. So still up 13.4%. So I would say it's still a clear winning session for SoFi, which did, again, touch a record high after it raised its guidance. It also said its profit surged fivefold in the second quarter, citing a flood of new members for its ballooning suite of products. Now, shares has, again, jumped as high as $25 a share, which was, the highest level we've really seen in this name, which was at one point still, I'd say, caught up in some of its growth phases, as we did see this name almost had meme-like characteristics when we first saw its public debut. But now, showing consistency and reliability, as annual net income now they believe should hit around $370 million, well above their $320 million target previously. Projections, though, following the really strong growth we've seen in the first half of this year. They concluded the first 6 months with a roster of around 11.7 million members, now over 17 million products. They added roughly 850,000 of those members in the second quarter alone. That was up 34%, along with 1.26 million new products, which was another 34% gain. And most of that product growth came from their financial services arm. Its online lending platform, though, did still remain popular, with revenue up in that specific segment up 30%, but more than half of their quarterly top line did come from non-lending products this time, which shows, again, a diversity of their revenue right now. And the street seemingly likes that variance in the mix and showing signs, again, of not just being this true lending company, but now offering more of that platformization method that it's been undergoing for years now.
Yeah, the thing that stuck out to me, first off, I like the call out too of the pullback off the highs. So in some ways, it is living up to the early theme of this earnings season through now about 40% of the S&P 500 names, which is early jumps intraday and then fading off those highs for the names that do move higher. But what stuck out to me, this wasn't from the results, but an interview that SoFi CEO had on Bloomberg TV. Whether it's just intuition from Anthony Noto or if it's a PR team that coached them, I just love the way he framed this. He said, we're appealing to overachievers in the United States. That phrase makes you feel like if you're not working with SoFi, that you're not an overachiever. Just how companies phrase things and how they present their information is so important. It's a company that clearly sees where they need to execute and how to frame things. They see strong credit trends from their consumers. And they, of course, had to get this in. Crypto and AI are huge tailwinds for financial services. So just weaving in AI and crypto, get some of those algos, see those words, can never hurt.
That is true. As much as you can really hone in on like developing your technology and also some of these maybe high income, more inflationary resistant consumers is something that's been very strong throughout all of the financial reporting we've seen thus far. I mean, financial stocks, anything exposed to right now the consumer or anything financial has been a boom post earnings, with the exception being our next name today, which is PayPal, unfortunately. PayPal today pacing for its worst day since February, as we did see still some positivities in their report. I mean, they announced that they'd achieved their 6th consecutive quarter of profitable growth. Adjusted earnings per share actually beat. Transaction margin dollars, though, which is a key measure of their profitability, did rise 7% from a year ago. And excluding interest on customer balances, this metric actually would have risen about 8%. But both total active accounts and monthly active accounts were up 2%, while transactions per account rose about 4%, excluding payment service provider transaction. And again, they were seeing more of this mix of profitable growth beyond just their online branded checkout, which is a niche from which the company is attempting to break out under the leadership now of a new CEO, who did take the helm back in the late stage of 2023. So all of this being said, they did actually raise their full year guidance, but some of these metrics, well, they do sound sure, like, we're seeing monthly active accounts up 2% and active accounts rose 4%. It was slightly below what the street had been pricing in.
Yeah, it seems like a current quarter miss when it came to guidance. They guide for their third quarter.
And for years, that has been the Burlington Northern. And this will put the Union Pacific in a position to challenge that. And so the Burlington has to respond because intermodal is the highest incremental operating margin business a railroad does.
Yeah, and of course, Berkshire Hathaway, which owns BNSF, is certainly sitting on quite a large pile of cash that investors have been fomenting to see some sort of deal activity happen. So we'll watch it. Meantime, one of the largest customers of the railroads, UPS, put out earnings this morning, withheld 2025 revenue.
If you call it that.
Yeah. Okay. So what's your prognosis? What's your takeaway from what we saw with UPS, especially since they have their own labor contract that they signed not that long ago, and